if the most, according to the dot plot, I mean, if the most likely case is that you will have to cut rates in the next 18 months, and given some of the concerns about, policy needing to react sooner and more aggressively, what would have been the downsides to cutting rates now? Why not just cut them now? Thank you.
So why not now? And I would say there was not much support for cutting rates now at this meeting. There was, as you see, a number of people wrote down rate cuts, but all of those, but apparently one, felt that that it would be better to see more before moving. And I gave a couple reasons why that is the case. First is just the fact that some of these developments are so recent that we want to see whether they'll sustain. So we felt that it would be better to get a clearer picture of things and that we would in fact learn a lot about these developments in the near term. Ultimately, the question we're going to be asking ourselves is, are these risks going to be continuing to weigh on the outlook? And we will act as needed, including promptly if that's appropriate, and use our tools to sustain the expansion.
Edward?
Yeah, thank you for doing this, Chairman. Edward Lawrence from Fox Business Network. How do you reconcile the conflicting economic data coming in? On one hand, you have strong overall growth. Consumer spending is strong. On the other hand, manufacturing numbers were a little bit weaker. You have growth in jobs, but coming in a little weaker. And then you have low inflation. And then specifically, what data are you looking at that you decided not to have a rate cut? What in that?
Well, you gave a pretty good picture. I mean, it's a complicated picture, and the answer is we look at all of it. But I would say the big pieces of it are this: the baseline outlook has been a good one, and that has basically been consumer spending coming back up in the second quarter. That is coming true, and consumer spending is at a healthy level, and that makes sense. You've got a tight labor market. You've got companies in surveys saying that labor is scarce. You've got workers in surveys saying that jobs are plentiful. You've got wages going up. You've got high levels of household confidence. So all of that underlying fundamentals for the consumer spending part of the economy, which is 70% of the economy, is quite solid. Job creation, if you take a 3-month average, is still well above the level of entry into the workforce. So that part of the economy is solid. You mentioned manufacturing, and we're seeing this all around the world. Manufacturing, investment, and trade have been weaker. It's not solely a domestic issue, and it may be that there are a range of factors that are contributing to that, including, for example, what China has done over the last couple of years in working to bring down its leverage. Some of it may be uncertainty over your supply chains due to trade developments. The Boeing 737 issues may be contributing in their own way. So their lower oil prices are contributing to lower investment, although they're also leading to lower gas prices, which supports spending. So there are many, many things. There isn't any one thing that explains it all, but it's something that we're watching. But you do see growth in services. So this pattern around the world of weak manufacturing, but growth in the far larger part of the services economy, which has led to low unemployment, good job creation, rising wages. So that's kind of the two big pieces of it that you see. Then you see the cross currents. If you lay the cross currents on top of that, concerns about global growth and trade developments, you have the full picture. And I think what we took away from that picture is that we'd like to see more, that we do see these risks, and what we want to do is we want to watch and see whether they continue to weigh upon the outlook.